All right, hello everyone. This is Shane with Trade ATS. I just want to welcome everyone to the webinar. So just a little bit of housekeeping before we get started. I wanted to remind some of the newer people that we might have on that we're going to stick to mostly trading theory and talking about the charts and all of that sort of thing. If you've got any technical questions, try to keep those to the technical support module inside of the classroom. We're not going to really be going over too much of that stuff here. If everybody could just maybe type a Y if you can hear me all right. Just a quick little sound check. All right, perfect. Okay, so we are going to go ahead and get started here in a second. We're going to keep the webinar to about an hour today. Want to also apologize for having to kick it back to today. Some things came up that yeah, we weren't able to get it done yesterday, but thank you all for making the time on a Friday to be here. Anyways, let's go ahead and hand it over to Wade. He's got some pretty useful things that he's going to be going over that I think will clear up a lot of misconceptions or questions that people have for the software and the methodology. So anyways, that being said, I'm going to hand it over to Wade. Thanks.
All right, thank you, Shane. I want to welcome everybody on the webinar. Let me get my screen up and running here. Okay, so my screen should be up. Can you guys just let me know that you see it and that you hear me and that we're good to go? Nothing worse than running a webinar when you're talking and no one can hear you. Ask me how I know. So, all right, perfect. Looks like we're up and running. So what I wanted to go over with you guys today, just really quickly, is well, let me paraphrase. Let me start by saying this: is that one of the things that we get a lot of questions on is basically how do I equate the master pattern scenario to the boxes and the liquidity lines, and how does that how do I see that? Because what ends up happening is a lot of people they get our software and they're looking for that idealized whipsaw back at, you get a box, you get a whipsaw, and then you get the trend phase, and they think that every time they get a box that whipsaw has to happen, after the fact, and it does a lot of the times. But the key is understanding that we are putting our software, our algorithm over specific price actions that happen and confirm in the market. And with the expansion phase, the thing that can happen in the expansion phase is, yes, it can whip back and forth. That can be a characteristic of what happens, but it also can just break out. That is a possibility too. So either way, it's an expansion. When you leave a box or you get a new white line, the expansion algorithm has triggered. And what for us as traders, it's up to us to look at the price action that happens after that and understand what scenarios can happen at that point. And then we deal with those scenarios and come up with trading ideas around them. And there's only two scenarios. One, it whips back across the box or comes back through the face in the idealized whipping back and forth setting, or it breaks out. But either way, you have your average price, which is that white expansion line that tells you where basically the tipping point is between long and short, and what's going to end up panning out on that. So looks like someone said my mic went out. Can you guys confirm you could hear me? I want to make sure it's not my mic and it's probably just their sound. All right, well, hopefully it's working all right. Okay, so anyway, going back to what I was saying, so that's one of the things that a lot we get a lot of questions on when they sign up. They're like, how does this help me deal with the master pattern? And the master pattern is something that you can always go back and you can figure out where you are in the phase. And basically, if you're looking for the point of origination of that whipsaw action, then you can go back and look at it, and you can basically look at how you're going to deal with boxes associated with that original point of reference. So I'm going to go back here in the dollar CAD chart. I'm going to kind of show you what I'm talking about. And this is because ultimately what you guys, in order to really do well with the software, you have to look at it as an overall map. Okay, you're putting together price action not only in the moment, not only right here at the live end of the chart, but you're also looking at the general area as a whole. The boxes, the lines, they all work together to tell a story. And we're trying to put the pieces together in that story to figure out what is the probable outcome of price. And then when we figure out what the probable outcome is, that's where we take trades and control our risk. Because when you're taking a trade, there should always be two things that are going to happen. You're either going to get paid on the trade, it's going to put you in the money, at least to some degree, or the original information you're trading based upon changes, and basically rules out that scenario. So that's basically the two things that should happen if you're doing this right. If you're just randomly throwing trades in there and hoping they work out, you're not doing this right. You have to look for those scenarios. You have to work out a model. Just to give you guys some insight, in major banks they have what they call quants. These are people that do quantitative analysis, and basically the entire job of a quant is to work out scenarios and give the traders information based upon, hey, if price gets to here, this is probably where it's going to head based on a quantitative model. If it gets to here, this is probably where it's most likely going to go and how it's going to behave. And they work out these scenarios, they give them to the traders to deal with. So what you have to learn to do is you have to be you not only have to have the aggressiveness of a trader, you have to be able to pull the trigger when the time is right, but you have to have kind of a quantitative mindset, understanding, where the predominant highs and lows are, where certain liquidity lines are forming or where they formed, and what if price gets to those lines, what is the information? What is probable to happen? If price gets to the opposite levels, or whatever's happening in that particular scenario, what is likely to happen? And you need to come up with a plan of action of what you are going to do if those scenarios pan out. And that's ultimately where you need to get with this. If you're just stuck on the I'm going to wait for price to get so many pips below expansion or above expansion, I'm just going to get in and I'm going to give it this much risk. If you're looking for a mechanical model like that, I'll tell you right now, it will never work long term. That's what ATS is about. It's about giving you framework that's relative to the market. If you're looking for something where you're like, I just need to work out my perfect risk to reward and my exact setup and my exact thing where I get in the market when it looks like this and it behaves like this and it does this and that's my trade. Well, the market cycles change. The size of the cycles change pipwise. The cycles may be in a tight range overall, where you don't have a huge average daily range, and the market's going to be a lot tighter. So a tight stop may work in situations like that. But when things open up, especially on the larger time frames, you guys have to have the flexibility to roll with that. And the parameters you set for your system, your kind of rules-based system, may not work. And then when they stop working, then you're going to lose confidence in what you're doing. So the ultimate answer to that at the end of the day is to have flexibility and understand the total framework and what is possible in the market that you're trading at the moment. So
Hey
anyway,
Wade,
yeah,
real quick, just to add into that point, I think a good example of that would be the fellow that we had that was with the ATS assistant, where he was looking at a market that was just, in kind of a trending market cycle, and he would he didn't really take the time to learn, how to manually trade and learn about the software, but he was just, every time that he got an A setup signal, he would just place a trade, and they happened to work out really well in the market cycle. because it was a trending market at that time. But as soon as it stopped and went into a range, then, it didn't really work out all that well.
Yeah.
Anyway, if you wanted to go in
Yeah.
on that at all, that
Yeah.
was
That's a
that's how it works out.
yeah, that's a good point. We did have a fellow out of Australia came into our program and just started crushing it. Um, I'm talking stupid gains. And like I said, we don't solicit for your guys' information. What you trade is your business. But this particular guy shared what he was doing and been trading a long time, but he was doing amazing. And he's literally just following the signals on ATS Assistant. And that's fine. The signals serve a very particular purpose to alert you to a specific type of criteria that's interesting for us that we want to look at. But the signals don't mean just pull the trigger randomly. It's not a get in here, get out here type thing. It's literally what it's called. It's an assistant. It's like if you hired someone to say, when we get a pullback like this below expansion against the overall trend, let me know about it so I could take a look at it. That's all the assistant is. But what Shane was talking about is he caught a particular trending cycle where it was throwing out grade A and grade B alerts, and he was following that. And the alerts are good. I mean, they put you into the point where you're either going to get paid or you're not going to get paid. But they put you into the criteria where this is kind of the sweet spot where things are going to happen. And everything panned out in that situation until the higher time frames of the market went sideways. And then he couldn't understand, what's happening. Why is this thing falling apart on me? All of these signals were working right up until now. It's not that the signals were bad. It's that he didn't spend the time going through to understand how to look at the higher time frames and understand what is probable now that those time frames are changing. The information is changing. For instance, if you're using a weekly chart as your directional bias and you're using a 1 hour or 4 hour to enter, and all of a sudden you've just had, let's say relative to that market, let's just say you've had 6 or 7 weeks that have pushed, say 300 to 500 pips, depending on the market. Then what you should know about that is that, you got to look back in that market, say how much does this market tend to run when it goes on a weekly run? I'm talking color after color, same thing. Understanding what's normal for this type of currency. Well, remember, in the 3 market phases, after you get a trend, when you get a consistent directional push, you're going to go back into the first phase, which is the box, or it's going to be very choppy, tight market. So understanding that you have an expectation that that's coming is going to help you understand how to treat signals from ATS Assistant, whether you're using them or not. But it's going to give you some baseline to understand that this is where what the market environment is probably going to be like. That way you can adjust before you get chopped up like everyone else. Because that's the thing with the markets, is that everybody does well in the trends. You almost don't, I mean, you just basically just need to buy or sell if you can see that a trend is happening. But the problem is that people don't anticipate what's happening next, and they trade themselves right into the box, or right into a sideways market. And those are the hardest markets to trade. That's where you end up giving back a lot of the profits that you made on the trend. So anyway, going back to what Shane says, that he got discouraged because he didn't go through the time to learn manually how to treat the information the screen gives you, which is an absolutely critical point to getting this, and doing this long term. So going back to what I was originally talking about, is that finding a point of origination where you do have that idealized scenario. If you have like the dollar CAD right here on the 1 hour chart, you see this box right here. We broke out long, whipped back and forth, and now we broke the low of the box. Now it comes back up, it breaks the high of the box, and now we're holding above this last low. But you can see the unfolding back and forth sideways movement, right? So in this situation, obviously the weekly chart is long, it's green, we're still under expansion, which is definitely a clue there in itself. But you see how if you look back on the chart, you can see that all this activity, you can tie it back to this point of origin in this box right here. And what it looks like right here is that the market started the expansion phase, the idealized situation where it's whipping back and forth. It now held, It's letting these people, anyone that bought up the market here, it's letting them stay in the money, represented by this liquidity line here. Comes down, pushes up, so it's holding that. So what it looks like is that the market is basically creating beliefs in a long market. But the problem with this is that the market maker's book is going to start to get really heavy on the long side. When the market just goes in a very easy direction, the market makers' books are going to get really heavy to that side, and they're eventually going to have to swap out those positions, because as retail traders, institutional traders, anyone that does business through that market maker wants to buy, they're going to have a trouble matching up to sell orders. That's the whole point of being a market maker, is to make a market. When you say you go to the market maker, whether you're doing it through an electronic dealing platform or you're calling them over the phone, which does happen still, depending on the size of your trading, you say, Mr. Market Maker, I want to buy. And the market maker, because they want your business, they want your spread money, and they want your activity at their bank, will say, okay, no problem, I'm willing to sell at this bid, or they'll give you a bid and an ask price represented by the spread. So that's their job, is literally to facilitate transactions. But the problem is that the market maker has to literally take everything, because they don't want to turn away business. So what ends up happening is that you got all the retail traders, even the institutional clients, coming in saying, I want to buy the market, I want to buy the market, I want to buy the market. The market maker is eventually going to have to, they're going to get heavy. If the market is going to go trend up and everybody wants to buy, the market maker's book is going to get really heavy on the short side. And if the market maker's personal opinion is that the market is going to go up as well, now they're holding a unbalanced portfolio full of short positions. So the only way to fix that is to manipulate the market short, to get some people discouraged enough to say, forget it, I think the market's going to go short now. Sell. The market maker could then take the other side of those orders, because that's the business, that they're in the business of taking transactions, taking on risk. They're going to buy from those people that they're discouraging, and then now they're safe to go and distribute that liquidity into a rising market. But the market makers are going to ultimately control the floodgates of which ways the markets go, based on how they manage their books of business overall, and how they're managing that risk. And that's what's going to ultimately cause the market to trend or not trend, because everybody goes through that gate, if you will. So in this situation, you have this box coming up, and you're starting to see the market, it's taking out highs, and people are feeling, okay, it's going to break, it's going to go long. And like I said, the market maker's book's going to get heavy with short positions from taking the other side. But if you look at our situation, this whole kind of business model started from right here. When you get situations where the market just whips back and forth, it shows you that the market maker is exploring the highs and lows and seeing what kind of liquidity is available and testing the water. As it comes up, you see we get a box up here, comes up, breaks this. We had this drop back here. We get a box which shows that there's no predominant belief right there in that particular area. It's kind of a neutral zone. We come up, take stops out above this high, and now we're coming back down into this general range over here. What it looks like to me is that if you're trying to trade this, let's just go back to the basic strategy, ATS strategy, is that if you're looking at, and like I say, you could pair any time frame you want, whether it's a hour into a weekly or a 1 minute into an hour chart. It's pretty fast. Wouldn't recommend that, especially to start, but it's possible. If you got that and you're pairing that to the weekly, right now would be our kind of our basic strategy. We're pulling down below. You can see we pulled back, we came back, tested the expansion line. Although we didn't get through it right here, that's a clue. You're coming back down, so you could have bought again down here. And what you're looking for is just to get back up to this expansion line right here. But in the context of what's going on, and I'm not saying it won't get back up, it won't go back. But if you look back to the point of origination over here, this is the last, really idealized expansion. This is where they really started testing the water. Then you can understand that they're leaving these positions in the money right here from this last low coming out of this full expansion. What this tells me is that probably if price gets below here, it's probably they're leaving those people that are buying the market, this is going to be a really sensitive point for the market to break short. This is where a lot of those people are probably going to give up. Anybody that's bought in here trying to ride the trend. So if I'm looking to trade back towards expansion in a situation like this, that would be a risk point for me, just looking in general, where I would say, look, if it gets below this line, there's a good chance that we could be overall, the trend phase could end up going short. And in that case, where's the last point that that the market expanded from? And if you look back, I mean, there's a lot going in here. Look at this one right here. Expands down, expands up, expands down, expands up, expands down, expands up. How many times did it break high and low right here? So this literally this box right here, that shows me that's a really predominant level for the market maker exploratory process right here. So if that's the case, painting that forward, that the significance of that box, if we break low, I would say there's a good chance that we can definitely get down to this level. But if I'm working on just taking a trade, looking to trade in trend, coming through expansion, like I said, looking at this overall activity, I'm not really going to want to risk much below here, because I think there's probably a good chance it's going to here if we break that, which is represented by liquidity lines that we have here and things like that. So I know it's a mouthful I'm putting together here, but hopefully you could try to kind of get your head around what I'm talking about and understand that it's not about forming an exact criteria of when you open and close a trade. It's about understanding how this overall business is taking place, what could happen, what are the scenarios that can happen, and then figuring out what your game plan is, whether one of two scenarios works out. And that's really ultimately where you need to get. But the basic strategy that we tell you to start with is a good strategy, but unless you keep building your knowledge and your feel for the overall market cycles, then what ends up happening is you're just like, every time it gets below an expansion line or above an expansion line, you just like push the button. You're like, go, I hope it's a good trade. Go, I hope it's a good trade. You have to start forming a more of an overview analysis of what's going on, and that will help you build your own mental filter of the opportunities that you take, and it'll help you avoid some eventual losses at the turn of trends. But overall, like I said, the situation, like running on trading the 1 hour into the green, the earlier you are to these rotations, you could still do quite well. For instance, we had this when we broke long, broke short right here. Okay, if you're rotating long on the weekly, you have a buy situation right here coming back up. You can see that it holds average price, gets below, but eventually breaks up, then comes down, tests that level right here, and then boom, right up through here, covering the liquidity lines. So the basic strategy is a good bread and butter strategy, but you have to eventually make it more than just a set of criteria and press the button. You have to make it more of an overall understanding of what's going on in the overall workings of the chart. And like I said, it takes time, but the bread and butter strategy works really well. If I'm going to give you some quick advice, in a situation like this where you see the markets running up, you can see every time you get below expansion, when you're in the weekly trend and it's going, you can see the clear direction. It's putting you into the money. Even in situations like this, you below expansion, come back through, below expansion, come back through, below expansion here and back here, come right back through. So you can see it works really well, but look at the situation here. We get below, it's high in the overall cycle. It's high up here, it's towards the high, you get below, comes back. This is letting you off the bus right here. When you get up and you test average price like that, and then you get an aggressive move, that right here, this type of situation is an indication that you're probably going to get a more significant correction. And at that point, you go up, test there, and then we'll fall back away. Those situations, remember, the farther the trend goes, the less and less probability you have of getting paid. So you should start. If you are trading every single opportunity, you should start to back off your risk.
Something also to note right there is that it's starting to stall out as soon as it hits that weekly average price line, which a lot of people email in, and I'll kind of email back a little bit of my thoughts about the average price. It's called average price because it represents the average price that people that orders were placed inside of the box. So when it hits that average price, there's a lot of volume there, and the market's going to respond exactly like it is now. That's where it'll start getting whippy. That's where it'll maybe pull back, back off of it and then go through, or it might just rotate off of it. So always something to look at. It could even be, you can even use those average prices as profit targets if you think that that makes sense in the situation.
Yeah. Yeah, absolutely. So like what Shane said, hanging under, we're at this average price at the weekly. This is a big turning point, whether we go long or short. So there's no surprises getting choppy right here. Um, you know, so going back to kind of the general strategy, because I know that's where everyone has got to start, and that's where they're looking to, get into a trade that has a good likelihood that's going to put them in the money. What you guys are looking for is we're looking for the deviation out of trend. That's where it all starts. And in a situation, for instance, like right here, we get a white line on this candle. As you can see, when that pops up, you're deviated, 20, let's call it 25 pips from that white line. So you have this deviation now. What you're expecting is that this is the first half of the whipsaw back and forth around this point right here. Any expansion line creates that tipping point. So what you're doing is you are seeing a clear trend defined on a higher time frame. You get a deviation out of trend with that higher time frame and a reference point of expansion. That is the tipping point that you're trying to trade back to, and you're expecting that as long as the higher time frame trend stays intact, that you will revisit that expansion line that you're using as your trade placement reference point. And if the trend continues, you will get up through it. You can see we came down through here, comes back, ranges out a little bit right at that level because that's the tipping point, and then there it goes. At this point in this type of trade, you got the initial expansion down, and then you got the return because the higher time frame is still intact. So in this type of trade too, trying to cover up here, these things are, it takes, what we're really trying to do is just get you in the money. That's really the biggest thing, is get you some sort of safe entry into trend. As far as you can let it ride above the expansion just comes down to where you expect the higher time frame could be headed and how you're going to manage the profits. But what we're trying to do is you get an entry, we're trying to get you from here to here, there to there. Same thing right here. We're trying to get you to here to there. And if you want to enter again, we're trying to get you to here, back up. But again, in this situation, notice that we're starting to leave this level behind. That should be telling you something. So, and doesn't mean we won't get back up there, but it means that I would give it some more room down in here to see, what could happen. So you're starting to change your expectation a little bit on that. So anyway, sorry, I know I ramble a little bit. I just got a lot of stuff rattling around in my head with this kind of stuff. So hopefully you guys took a few little nuggets from there. And like I said, we're always happy if you guys have any trades that you're looking at or things that you've been going over. We're always happy to give you some commentary on those. Shooting us emails to those ones would go to admin@tradeats.com. And more than happy to give you some feedback on that. We do have some questions here. I'm going to go through the questions and try to catch up here for a minute and see what you guys are saying here. So hang on real quick. Give me a minute to read for a second here. Okay, so question from Mohammed. The question is, can we use a trend line to our advantage? And I don't know if you're talking about, and sometimes people will call our expansion lines trend lines, even though they're, we call them expansion lines so that we all know what we're talking about. But they do hold trend as well. But if you're talking about using a trend line, in a situation like, let's say that you throw a trend line on and you're like this, okay. Can you use that to your advantage? You can, any way that you can define trend accurately is important. But what I found is that the trend lines, sometimes they can lag in situations where, you get a rotation in a situation like this right here. You would have never known that you were getting a rotation. And if you were looking at a daily chart or you're looking at a lower time frame, a situation like this could be an opportunity where you get below, you see that this rotates your higher time frame, pulls back below right here, below these average prices, and then you're in for a snap. Whereas if you use a trend line, I mean, you wouldn't have really known, I mean, unless you're sticking your trend line, let me see here. Unless you're sticking your trend line up like that immediately off that low. But it's, what I find is that placing trend lines is great for hindsight analysis, but it's almost, in my opinion, it's almost better to use a really loose moving average than a trend line, personally. But I've never been big on technical analysis using trend lines ever. In the over 10 years I've been trading, I've never done it. So always been heavy price action trader. So whatever, at the end of the day, if it helps you define trend direction, fine. Because if you got, whether you're using a loose moving average or whatever, ultimately what we're looking for is we're looking for a trend continuation, and we're looking to find entries above and below expansion to find a safe entry into that trend. That's the starting point of this whole process. I find that it's more reliable to go off of the color candle on the Heiken Ashi. And also too, I like to see the cycle relative to the box. Like if I know that we go into a box on a weekly, that tells me that we're probably going to have several weeks of sideways choppy movement. So a box on the weekly, if it's a market that you specialize in, that you're trading, that you follow, a box almost means like go take a vacation to me. It's like, forget it. Let's wait till we get the volatility signal, till we get the expansion out of the box. That actually tells us, okay, now we're actually going to have some market movement, and then you get interested in that trade. That's, I find it more reliable to look to reinforce the trend based off of how I see price reacting coming out of a box, how I see it reacting at liquidity levels, at expansion levels. That I like to go more off of that. But like I said, you guys are all grown people. I know a lot of you guys have been trading a really long time, and we all have our little things that we do. So if it helps you and you can build consistency off that, then so be it. I just don't personally like trend lines. Okay, let me catch up out here real quick. Okay, question from Mark. Question super common, Mark. How to manage profits when you're getting into a trend, and it really all comes down to having that reference point. The expansion, those lines, they're super significant as far as showing when we're going into a long market or when we're going to be in a short market. So in a situation, we'll take this, if you're looking, the market's going up, you see the higher time frames have already rotated. In this case, we would have been holding long on the weekly. We're starting to pull up. You can see that expansion lines are starting to stack long. So right here, long. So you can start to see the architecture going in trend. When you get down below this, this was a great entry right here. It was early to the trade, early to the trend. You got the situation where it pulls long, holds above this expansion, you're starting to get this rotation. So this one would have been a good entry just down here in this rotation somewhere, would have been fine. You're looking to get back up to the expansion. Now in this situation, when you come up and hold expansion, remember none of this has happened, and we don't get paid for hindsight. We get paid for real time. So right here in this situation, when you come up and you hold that expansion level right here, that is a clue that it could be falling apart, similar to what happened right here. Okay, that is a clue. Why is it not getting through expansion? So in a situation like this, I would be ready to dump the trade pretty much when we got below this low right here. I'd look at it here, it would have put me up a few pips. At this point, when I see that, I'm heavily monitoring this situation. If it gets down below, or I see it, we start to get aggressive movement to the downside, I'll just close out the trade and give it more time. Because if that's the case, then we're probably coming down into these levels. But in this situation, it didn't. If you bought on the rotation or anywhere through here, then you're looking to come up. We had a little pullback right here, form a box, but then we just had a straight breakout in trend. Ultimately, whatever this action, this price action happens, the decision point in a situation like this would have been enter somewhere around here. Don't have to get it perfect. Expectation ultimately is if this trend's in a hold intact, that you're going to get up through this white line. But there could be time before that happens, time and more price activity. So in this situation, you would have held, but like I said, I would have bailed if price got down, around this point down here or below this low. Probably would have bailed and see if I could get a better entry, or at that point, the entire overall trend might fall apart. So again, it's one of those situations where you get paid or information totally changes. When you get above expansion, that's where you got to start managing the profits. And that's where you got to start looking at where liquidity lines, you got to start looking at past levels. And we get those drawn forward from the liquidity lines. Those are possible areas that you could cover at. So a good thing, we're never, ever going to get the extreme highs and lows. Don't even try. We're trying to carve something out of the middle. So when you're trying to manage a trade, you can look at liquidity lines. You may have bailed very well on this one right here. You got the reaction. So that's a call you could have made. That very, very well could have, and you could have cut it short before you had this spike. But one thing that really helps is how early you are to the trade. I find that that's going back to the whole grade A trade concept. The grade A trades they're at such an early stage in a trend that they can turn on you, and the market can range out. But the ones that you feel more confident about, depending on how your higher time frame, your supporting time frame looks, those grade A trades, when they do go for you, and you get above your expansion line reference point or below in that trend, those are ones that you may want to let hang out further. So in a situation like this, you can see we had this overall whipsaw back and forth. Looks like we had a stop run down here. It comes back up, whips down, holds above this average price. At this point, I'm starting to feel like, okay, we're going back in trend. You get this one right here. We're still early to this overall area if the market's in a go. So in a situation like this, I would really start to let it hang out because you're very potentially early to a trend. So that's where you can, if you manage it right, you still got to be careful because you are early and it can fall apart. So it's you really have to let those grade A type trade setups, you really got to finesse them and you really got to pay attention. But when you can get one of those in the money like this, that's a situation where you've now bought yourself some choices. At that point, you're in the money on that grade A opportunity and you're above the original expansion point reference point. You've bought the right to see where it goes. And I don't have a crystal ball. I don't know where it's going to go, but you bought yourself some crazy good trade placement. So, that's one thing. As the market goes up, as it keeps going, you start to see that it starts getting chopped out. Remember, the farther it goes, those grade B opportunities, still good opportunities, but those ones I'm going to look more just to cover at expansion. Down here, up to here. Or just monitor it around there. I'm not going to give them as much leash just because I know eventually it's going to fall apart. Same thing like here. What you don't want to do is you don't want to see the market go. You see all these opportunities pay. They're all paying. And then you're like, I can't take it anymore. And then you rip heavy on this one. And you're like, oh, man, this doesn't work. You have to recognize the beginning of those rotations. And you have to have confidence in the rotations based on the architecture unfolding and the probabilities associated with it on the higher time frame. Because at the end of the day, the trade is the higher time frame. The lower time frame is just some sort of decent trade placement and an expectation given some key levels. That's it. If you don't feel confident in that higher time frame that it can progress, that should tell you a lot about what you want to do on the smaller time frame. Okay, so we just got a bunch of questions that came in. Hang on real quick. Let me catch up. Okay, good question from David. What are the best hours to run the ATS Assistant? Depending on the time frames, if you're only looking for higher time frame opportunities, I'd let it run all the time. And what I mean higher opportunities, I mean like using a 4 hour and up. I would, or even a 1 hour, you'd get away with that. What you do got to be careful with is you got to be careful with the low volume periods through the Asian sessions, the Australian Asian sessions. Depending on the markets, they do tend to form boxes, and those tend to. I know there's whole strategies on YouTube and whatever based around people saying that the Asian session is the overall accumulation point of the market. That's where it starts from, and basically that always forms the box of the three phases. That's not always true, but it does tend to happen because there's such thin liquidity in that market. There's just not enough fuel in the market to push it one way or the other. So that does happen, but you don't want to hang on that too much as like that's the rule. It always happens. And so what can end up happening is that you can get signals on ATS Assistant in those time frames, and you just need to understand that there's a good chance that you'll get a better entry coming into London and New York session, because that's where there's actually gas in the market to push it somewhere on at least the major markets. I'm not talking about exotics or anything like that. I'm talking about major currency markets. So you can let it run all the time. Just be very careful in those times. And on the lower time frames, I had one guy running the Assistant on a 1 minute into a 15-minute, and he was trying to trade it all through the day. You were going to absolutely lose money doing that. You want to ignore low time frame Assistant setups. If you have it running, it's fine, but do not try to trade low time frames in off market hours. You will get beat up, especially if you have your average trade take on those small time frames. Even in session is not going to be super high, just given the nature of those types of trades. If you on average take 5 to 15 pips on a trade, and you have a spread that's say average of 2 pips, you're at a pretty big percentage disadvantage, and now you're just opening a million trades. So if you're going to trade low time frames, you want to be like a sniper, and you really want to be like really paying attention to how you place those trades, and you only want to do it in an environment where there's volume to actually take the market somewhere. So that's my advice on the Assistant. Mostly ignore everything on say a 1 hour, 4 hour to 1 hour and below during off market hours. 4 hour and above, daily timeframes, those don't matter, because at that point you're lining up with macro fundamentals on the weekly, monthly charts, and that's where you just get the day break, the day trending action, and at that point you can enter those at any point. I will tell you though, on the Assistant, the higher timeframes that you trade, you need to be way more flexible with your liquidity and your margin. You don't want to go all in at one price level. You want to be flexible, because if you're trading a 4 hour chart or a daily chart for entry, chances are like 100% of the time, you're not going to get it perfect. So you need to be able to, if the trade goes 50 pips against you, you need to be able to average in, because it's probably still a good trade. You just didn't get it perfect. There's nothing more frustrating than going all in at one price level because you think it's going to turn immediately from here, which it pretty much never does. And now you could have got a better average position. So that's just my opinion. You could do what you want, but I would keep flexible on those higher time frames. Okay, got one here, Euro USD 4-hour, 15-minute. Let me go take a look at that. Come on. I don't know why our internet's we've been having problems with internet speed here. Okay, there it goes. Okay, we're definitely trending long. So if you're using the 4 hours as your directional bias, then obviously we're long, we're above expansion. This looks like it probably would have been a difficult trade just because of how the colors worked out on the HA, but overall you should be long for sure. That should have been the expectation. Let's take a look at the daily. Daily's long. What I see on this actually, especially the aggressiveness of this breakout, it looks like there's a good probability we're coming back to this price right here, this expansion. Difficult to enter today or down here. I mean, this was, let's see here. Yeah, this was kind of a difficult trade, but what I do think, I think this thing is forming to be to set up pretty good to the long side. It could do whatever it wants, but the fact that we came down, we held above this expansion down here, didn't even touch it. It shows me that the market makers are holding this direction intact, which shows me that there's a good probability we're probably going to at least get a mean reversion back to this expansion level. In that case, what I would do today was kind of just setting the pace for that trend, going back through this activity here. I would look to trade long in this pair over the next week. I think next week may be a decent situation to the long side, but I'll always wait and let it pan out. Don't guess. Wait till the market sets up, gives you something that you understand, something you can quantify your risk by, and then act. I wouldn't just jump in saying, oh yeah, it's definitely going long. Right now we're extended. We came through these liquidity lines here. There's a good chance we could pull back. We could pull back all the way back to here if it wants. So you want to wait till you get some new architecture in the chart so you can base your reference point on. But anyway, yeah, definitely I would say long Euro USD, at least to this expansion level, which is, if we want to forecast, it's not very many pips, but overall the ups and downs, it's a total of say 70 pips from where we are right now. But overall ups and downs on the 15-minute chart, there could be 100 pips of opportunity on the way up next week. But overall, kind of a thin market. Euro dollar doesn't move like it used to back in like 2011, 2012. There were some pretty crazy things happening with Greece and all that. Those were fun days. But Euro USD is kind of settled since then. Anyway, that's what I think. This trade right here, we'll go if you're looking at the 4-hour. It is good sometimes if you're trading 15-minute to 4-hour to keep a daily handy, because the daily is close enough with the 4-hour where you do get some information as far as where the 4-hour is headed, and you can understand the overall direction of the day. So one thing I'd recommend is using the daily as a kind of off to the side filter for the 4-hour if you are looking for literally a day trade type scenario. I'm looking to be in session and out before the end of session. Use a daily to kind of give you some sort of mediation for the daily direction, and that would have helped you in this situation. Like if we look at the 4-hour here, we have the dailies clearly long, right? And hang on. I don't know why this internet's so slow. Okay, there we go. Okay, so the daily was long, but you can see that we're above our expansion line. That would have helped you filter out this red candle situation. And in that, um, as you got back above this average price through here, it would have given you a situation where you may have had confidence as you saw aggressive price moving up, just to jump in long, trading against this expansion level right here, because you know that the direction of the day is already, it's holding long at that point. So that's why I don't. A lot can happen in a daily candle as well, but if it's a situation where you're expecting a trend long, then that can serve as an extra little filter to kind of help you build some confidence in the direction. Okay, question from David: can I use the 4-hour for confirmation and the 30-minute for entry? It's pretty close. That's more of a momentum pairing than a statistical trade placement pairing. What you want is you want the stability from a higher time frame to reinforce your overall direction, but you want the flexibility of the lower time frame coming from a statistical approach, how it dances around the average price of the expansion. You really want that just for your trade placement. So if you're going to use the 30-minute into the 4-hour, may be useful if you're trading like a 5-minute into a 30-minute, but even that's kind of close. It's kind of, honestly, it's a little bit of an odd pairing. I'm not saying that there's not some value you can get out of that if that's something that you're used to looking to, but I think what's more common is if someone would be trading like a 5-minute chart, they would use a 5 into the hour, and then they would reinforce the hour with the 4-hour, just to use kind of like what we did with the daily here, filtering out situations like this. The 4-hour can help you when you're trying to work out where the hour is headed. But like I said, it's kind of an odd pairing, and if you get usefulness out of it, by all means. I don't have, I don't really know what to say on that. Maybe if you use if you're using it as a 1-minute pairing into a 30-minute into an hour, I suppose that could be useful, but then now you're trading the 1-minute chart, so you better really be accurate on what you're doing. Okay, the golden question: where do I put the perfect stop loss? The almighty stop loss, the perfect one. Where do I put it when I know that the market is not going my way, the exact moment, so I can trade perfectly? Let me show you. It's a difficult question, and it comes down to the architecture of the market that you're dealing with. If I told you, you know what, a good place to put the stop loss is at 15 pips. If you're trading a 15-minute chart, use a 15 pip stop loss. That's just perfect. It would maybe work a few days and it wouldn't work later on. You have to look at the reference points of the chart. In a situation, let's just talk through a scenario. Let's say that I see the 4 hours pushing up, I know the daily's pushing up, and let's just say I just jump in right here on this candle. I don't see, this is what you see right here. And I jump in right here, buy. What I would want to see is I would want to see it hold above expansion, because I'm betting on the fact that we're going to get some sort of trend to expire, or to some sort of trend to take place on the 4-hour. So if I'm buying right here, and then all of a sudden market takes off, and in this case it went, but in this situation, let's say it went up, it put me up a few pips, and now I see it dipping back. Right now, I know that if I get below this reference point, because I bought basically the breakout above this expansion, if now price is dipping below that, that becomes my risk threshold, is that expansion level. So that's a situation where that's because, to me, if I'm buying and that now price gets below that, the information is changing. Therefore, okay, maybe I didn't get it perfectly right, or maybe I'm not seeing something, or maybe the 4-hour just isn't going to pay. That would be a situation where I would get out. Let's find a different one. In this situation, these ones are difficult, where they're kind of like hanging out. You've had this move up, you got a new box, and now boom, this is maybe a grade A trade signal right here. You come out of the box. Okay, now what? Well, you could very well come back into this overall range all the way back down to this average price. So in these situations where it's a fresh move, I like to wait to see a rotation. Sorry, my other phone right here. I like to see a rotation because then I could quantify my risk by this low right here. And I know that I'm going to get up. If I get up through the expansion line, then at this point, you can see this candle's holding above expansion. Now I'm in the profit, and now I can just see where it's going to go, right? So, but that's where I like to, if you don't have other framework around there, then you're going to want to manage your risk by the highs and lows, and see where it could possibly head. Situation right here. Again, if you're going to get your below expansion, let's say that your higher time frames are long, you buy on the rotation or in here, comes up, holds below expansion. That's a clue of continuation. I would probably get stopped out right below this low in this situation right here. I would get stopped out. I would say, okay, where's it going to head? Now, is the whole thing going to fall apart? Is it going to come back down to here? Let's find out. Let it fall out. It comes back down through this expansion line, going back the original reference point. We're still dealing in this range right here, started by this point of origination, which is what we started talking about in the beginning of this webinar, right? So now we got expansion high. This one didn't take off, came above the active high here, and now it's falling apart. Well, look at that's that idealized expansion, whipping back and forth, down, up, down. Okay, so if you're putting that framework together, as you turn back up, you could have very possibly bought again right here. Comes back, holds that expansion. And this is where it's like, okay, what's going on here? In this situation, I probably would have had a stop loss below this low again. And like I said, this is difficult. Also, this is a pretty thin market. When you get a move and you see that you're just getting this thin market, you're going to get a lot of activity like this, which just is a feel you got to develop over time. But in this situation, you're still thinking, okay, is the market going to break long? I see the daily's long. You very well may have got stopped out again, but you should not be taking huge losses on these. These should be, in this situation, if you broke long right here, you saw that it tested this expansion. That's a clue that you may need to give it some more time. So if let's say you got in here, you bought, you get a clue here, it reacts, you close out here. Break even situation. I know it's going to take time to learn that, and you may not get it right. If you're just saying, oh, forget it, I'm going to give it to this bottom of the low, well, you'll take a little more hit on that one. But now let's say, okay, now it breaks down short again. Now we broke this low again, and we're getting another reaction. It's just forcing the point that they're because it's not moving short either. So if it's not moving short, and you know that the statistical trend is long, these are all clues, and it's possibly going to give you a better entry price, or it's going to give you a situation where it's just trying to throw you off the scent. Market makers still trying to drive. They're heavy on the long side or on the short side because of everybody that wanted to buy up through here. So when you have activity of the market where it's pushing down like that, and it keeps making these new lows, but they're not progressive. They're not really significant. That's a clue into the situation of this overall market. So again, this is a difficult market to trade, but if you hang with it and you eventually catch that 4-hour break, then you put yourself in line for a situation like this. So going back to the original question, where do you manage a stop loss by? You have to, if you don't have a lot of architecture in the chart, you got to go off of the lows, the recent lows, recent highs, because that's where you're going to start to get new architecture and significant points. One thing that I like doing is when you get a trend that is more developed, I like to use the expansion lines. So you have a situation where you get above, here's a trade, you get above, here's a trade. But I like in a situation like this, you pull back down short, you get above expansion. If you look back at the expansions in trend, these they almost act as like a stair-stepping system going in trend. So those are other things that I like. I know that if we in a lot of cases, if the market just doesn't care about an expansion level, it just blows through. That's a good chance that you're going to get you're going to get some sort of bigger correction. So I like to look at those previous points. A situation like this, come down, we're above expansion, holds the expansion level previous, and I see that reaction, stop loss can go right above here, and I'll enter right here. So again, it's a question of not having this is always a safe expansion or a safe stop loss level. It's about what the architecture that you're dealing with allows for. Because you don't want to just be getting in and out based on your feeling. Then this whole thing becomes pointless. You have something that gives you accurate architecture, but you may not have enough architecture at the moment that gives you a risk allowance that you're comfortable with. And if that's the case, you don't take the trade. You let the architecture build, let the opportunity come to you so you can quantify it, and then you take action. You're not going to get everything. You're not going to get every move in the market. You're trying to calculate, you're trying to take a few risks that are calculated and that are understood by you. And that's it. If it goes, the market takes off, you miss it, it wasn't your trade. There's always, 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 I promise, always another trade. Okay, so we're kind of getting above an hour. I wanted to keep it to about an hour here, but I'm really happy you guys are putting in some good questions. So hopefully you guys are getting some benefit out of this. Okay, question from Jason. Can you explain what constitutes a grade A opportunity from a technical perspective from the time frame? The videos for the assistant go over all of that. They show exactly what a grade A and grade B opportunity is. So I definitely say go check those out, Jason, because they'll explain it. But basically, essentially what it is a grade A opportunity is where you get a rotation on your higher time frame. And a rotation means literally just the candle color changes. That's all the algorithm's looking for. It's actually very basic. You're getting a rotation, say on your 4 hour. And what it's going to do is it's going to give you the very first counter trend move above or below expansion against your supporting time frame. That's the very first one is going to be a grade A opportunity. And the reason why we call it a grade A is because if your higher time frame is going to stay intact, then that's the very first opportunity into that trend. In this situation, when we pulled long right here, you could see that we're above expansion. You would have got a grade A probably right here on this spike. If you're a grade A opportunity trader, you know that if you feel good about the 4 hour and you think it's in a hold and you see the daily coming around, you literally just pull the trade right here, boom. And you just manage it back and forth because you're expecting a significant break on the 4 hour. Grade A opportunities, they're not great for taking them. You're just taking the opportunity, taking it to expansion and covering with a small profit. You're betting on an overall market rotation, and this is your very, very, very first opportunity to explore that. So in a situation like that, you may give it some room. You may actually quantify your risk coming back down to here. So you're going to pull the trade here, you understand, and you're going to monitor this activity because you're ultimately in it for this. And the grade A opportunity puts you in that situation. So you may choose to only be a grade A trader or opportunity trader. Grade Bs are fine for entering a pre-existing trend, but they're riskier. They're riskier and they're not risky because you do have more confirmation in the trend because now it's already happening. But also too, the trend can end. So the grade B opportunities, it's not that they're not good. They have a different expectation. Whereas a grade A trade really gives you the ability to really knock some trades out of the park. But that's the difference. But I would definitely go over and check out the videos in that. Okay, Avery, I'm trying to understand your comment here, but you're saying basically it's a good thing to liquidate your trade position and move your stop. So yeah, that if I'm trying to get what you're talking about here, but what you want to do, especially if you're trading higher time frames, is you want to give yourself the ability to build a position. You don't want to go all in at one level. I mean, unless you're trading like a 1 minute chart, that's kind of a make or break thing, where it's like you better get in the money or not. And you're probably trading high leverage, which is a dangerous game. You really got to be good and have your head in the game if you're going to do that. But even with a 15-minute chart in a situation like this, if you feel good about the 4-hour, you could have entered right here, you could have entered again right here, could have entered again right here, because overall this is not a huge pip range in this situation. Because you have confidence in that 4-hour, you could have just averaged your way in. You don't always have to be in or out of the market. You just build a position and you use a lower leverage to do it. And you just expect that you're going to do it. Expect that you're going to build a position. Now with the grade A trade opportunity, you could go heavier on those. And then you could have built a position, you're waiting for the 4-hour to break, you add more to the position down here because you see the overall unfolding, you're just monitoring this general price range. You could definitely go heavier on that because the upside is much greater. But as a rule of thumb, it's a good thing to always break your positions down and deleverage so that you can be creative. You guys read, there's an interview in the New Market Wizards book by same Jack Schwager. I always pronounce his name wrong. Anyway, I have a book here somewhere, but there's an interview in the New Market Wizards, and I think it's the very first one. Guy, it's a currency trader. He talks about his strategy. This guy's huge at Salomon Brothers, a legendary currency trader from the 80s, and he always talks about I put my positions in, and he says I always give myself the flexibility to scale in and scale out. And the reason you do that is because a lot of times, like I said, no one's ever going to get the top and no one's ever going to get the bottom. You may do it every once in a while, but it is not the rule. So if you just accept that that's part of the game, that if you plan on breaking your positions up, it gives you so much more flexibility to build a position, and you're not so stressed because that initial trade isn't your whole margin. If the market goes 10, 15 pips against you, so what? It just means you get a better entry. Doesn't mean that the trade's bad yet. But when you go all in at one price level, then you're going to number one, you risk a higher loss. Number two, you risk being out of the market in general. When you trade lower position sizes and you're able to give yourself that flexibility without the stress, you have so much more creativity, and you can just build that position and work the market. And then ultimately, let's just say you get a grade A opportunity, you put on a partial position, and all of a sudden it just falls apart and it comes back into the range, and the overall higher time frame doesn't take off. Now you're losing at a very minimal level. But let's say that it does hold, and now you're able to build a position around that based on giving it some more time to pan out. Then you can put yourself in a much better position. So scaling in and out, I definitely think is a good thing. It takes some practice, but you guys should always be trading low leverage, especially to start. It's someone that gets into trading in general, and they go to these CFD brokers and these high leverage brokers that talk them into putting a ton of money into their trading account and trading a short-term binary strategy or something like that with a high leverage. It's a recipe for disaster. Your education in Forex doesn't need to be that expensive. So just start with something small and just build the skill, and make it not stressful. That's definitely, so just my opinion. Okay, let me catch up here. Okay, does the size of the boxes wider or taller have any meaning? From Benjamin. Thanks for the question, Benjamin. No, that's just the way the price action has confirmed. ATS will do what price action tells us to do. There's no settings on it. There's no predetermined a box can only be this size or that size, and this size means this. What it means is that there was indecision in the market. It's a place where the market maker can now start managing their book effectively from that point, depending on what they're holding. If they're heavy longs or heavy shorts, they can use that as a reaction or basically the start of their unwinding bad positions or pushing the market into a profit. So it's what the price action is, and that kind of goes back to what I was saying about stop distances. And there's no set stop distance, because the market, you may have boxes that are 30 pips wide because that's the volume in the market. That's who's playing right now. So a box is a box. A box, when it breaks out of the box, it'll give you an expansion line. From that expansion line is a tipping point. You get expansion lines also without boxes. The highs and lows relative to those expansion lines don't mean anything either. That's just the swing of the market. And that is a good gauge, like I said, to understand what kind of actual money is in this market right now. Who's actually interested? Is it big players, or are they letting it set up? And, is there not a whole lot of liquidity? So yeah, no difference there. A box means a box. All right, guys, I see we got a bunch of stuff coming in here. We're going to actually have to cut the webinar here. And if you guys have questions that we don't get to, feel free to email them in to admin@tradeats.com. Give us some more time, because we do have to keep these things kind of on a limited basis. We do got other meetings we got to get into here. Let me see if there's anything simple that we can answer here, just to keep things going here. So. Okay, I think everything's pretty, most of the stuff is, I'll tell you, it's the same thing over again. Where do I put my stop, and how do I enter the market, which is the golden question. The answer to that is the architecture the market gives you. If you don't have the architecture that supports a good risk ratio, and when I say architecture, I mean that you have a liquidity line, you have an expansion line, you have something that's relative to the market you're dealing with in that price zone, that you can, with some confidence, say, if it gets below this line, it means this. And if it does that, I'm going to give it this much room. If it gets above this, it means this. And in that case, I'm going to let it run, or I'm going to give it, depending on what the trending direction is. What you guys are trying to do getting started is you're trying to make gains in trend, because you can look at this as a general map. You can look at one time frame just like this and just try to figure out where it's going to go. A lot of people just use one chart to trade. You can do that because it is giving you an overall map. But the thing with going off the trend, even on the 4-hour situation, is that because the market's trend, that gives you a significant advantage. When you catch those trends and you're early to them, you have situations where, like I said, going back to the basic strategy, look at it running down, 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 all holding red candles. Every time you get above expansion, you come back through. Get above, come back through. That is what keeps it safe and consistent. If markets didn't trend, they would truly be random. But the fact that they do trend shows that they're not random. So you need to take, it's like if you know that a market trends, that is a significant piece of information to understand where to form your bias towards, your directional bias, where you think the market's going to head. And then when you are a master at trading the trend, it just makes your life so simple. There's nothing worse than being long, short, long, short, long, short, exploring everything of the market. And then what you do is you realize that you were in a bunch of trades, and you look back over the last 2-3 days or the last week, and you realize, oh, it just went up, or it just went down. There's nothing more frustrating than that. And so the magic of finding the trend, using the expansion lines to divide the buying and selling zones, when you can latch onto that and you can stick to that trend, literally the trend is your friend, like they say, the truism. That's a significant thing because it adds consistency to your approach, whatever your approach is. So trend is a significant thing to track, and let it give you that probability on your side. Don't ignore it. Don't try to be long, be short, be long, be short every other minute. Look for the trend, and if you can't find a discernible trend, good thing to do is just not trade. So anyway, that's it. I want to make a quick announcement too. It's been brought to our attention that there's been some people that are basically they're trying to copy our program, and there's some things out there that we've run into. They're not. This is some people, some basically scam artists are trying to take things similar to what we do, and they're putting stuff in our YouTube channel comments and things like that, saying that they have. What I want to do is I want to make an announcement. anything that is not from tradeats.com is a scam. If they're trying to use our name or anything that they're doing, it's dangerous. It's a scam. We do not endorse anything that's not from our website. So if you look at any information that does not come from our official YouTube channel or our website or from us directly on our email, we have no affiliates. There's no affiliates. This is not licensed out to anybody except our users, and you have to get it from us legally if you want it. So I would just be careful if you do run into that, or anybody offering that's trying to say that they have what we have. They don't have what we have. So I just don't. We had some people that got scammed by some people that were trying to say, that they had, our software, and they just take their money and don't give them anything. Like I said, just anything from Trade ATS has to come from tradeats.com to be real. Don't let anyone else tell you any different. Like I said, we have no affiliates that we allow to give our software out or anything out there. So if you do see anything, or someone approaches you online, or you see someone posting in the comments on YouTube, ignore it, because it's not endorsed by us. So just want to put that out there, because we don't want anyone getting in a bad situation with these scam people. So anyway, that being said, appreciate all you guys being on, and we will look to get on the webinar next week. We are going to land on a set time. I know we've been kind of exploring different times, and we've had me and Shane both have had we got some family that is in the hospital, so that's kind of been throwing things off on a personal level. So but anyway, hopefully that things are getting a little bit better on that. But that's what caused our change from yesterday. So but I think we're going to probably just land on Wednesday, probably at 10 a.m. As our just standard webinar time. That way we're not moving it around constantly. So anyway, but we'll definitely send you an email with the invite when we get closer to that. So anyway, everyone have a great day, afternoon, night, wherever you are. Appreciate you guys being on, and we will catch up with you guys soon. Thank you very much. Talk to you later.